Welcome to The Explainer. So, you've probably heard about people trading currencies right from their living room. But how do they actually do it? Well, today we're going to break down the massive world of Forex trading into simple, understandable steps, perfect for a complete beginner. Let's just start with a number that's, well, it's kind of hard to wrap your head around. $7 trillion. That's not some country's GDP. That is the amount of money that moves through the Forex market every single day. It absolutely dwarfs the stock market, making it the largest, most liquid financial playground on the entire planet. So what even is Forex? At its heart, it's just the global marketplace for swapping one currency for another, and it's all done online. The biggest difference from, say, the stock market? It's open 24 hours a day, 5 days a week. This isn't about waiting for a bell on Wall Street. This market literally follows the sun around the globe. To navigate this world, you've got to speak the language, right? So let's dive into the core concepts, the stuff traders are actually talking about day in and day out. First thing you need to know, in Forex, you never just trade one currency. It's always a dance between two. That's why we call them pairs. The first one is the base, and the second is the quote. So when you see EUR/USD, you're not just buying euros. You're betting that the euros is going to get stronger compared to the US dollar. Now, these pairs come in a few different flavors. You've got the major pairs. They all involve the US dollar. They're super stable, and they are without a doubt the best place for beginners. Then you have minors and the really wild, volatile, exotic pairs. And seriously, if you're just getting your feet wet, stick to the majors. It's the smartest move you can make. Now, here's one of the coolest things about Forex. You can make money whether the market is going up or down. If you think a pair is going to go up in value, you go long. That's a bullish move. But if you think it's going to drop, you can go short and sell. That's being bearish. You literally have the power to trade in both directions. So how do we measure all these tiny little price movements? Well, traders use a tiny unit called a pip. Just think of it like inches on a ruler, but for currency. It's the universal way everyone keeps track of their profits and losses on every single trade. Okay, so you're learning the lingo. Now let's talk about how to read the map. The absolute key to trading is figuring out which direction the market is already heading. The golden rule here is pretty simple. Don't fight the market. You want to ride the wave with the overall direction. But of course, the big question is, how in the world do you spot which way the wave is going? When a market is in an uptrend, I want you to picture it climbing a set of stairs. The price pushes up to a new step. That's a higher high. Then it pulls back a little to catch its breath. That's a higher low. Then what does it do? It pushes up again, past the previous step. That pattern of higher highs and higher lows, that's your signal that the buyers are in control. And of course, the opposite is true too. A market can be in a downtrend, which is like walking down those stairs with sellers in charge. But sometimes the market isn't going anywhere. It's just bouncing back and forth sideways. In those markets, you know what the smartest move is? Often, it's doing nothing at all. Just wait for a clear direction to show up. All right, let's get into the really powerful stuff, the tools of the trade. And I'm not kidding, these next two are absolutely critical, and they can be dangerous if you don't respect them. We're talking about leverage and risk management. Leverage is the thing that makes Forex so accessible. It's a tool from your broker that lets you, for example, control a $100,000 trading position with just $1,000 of your own money. It basically magnifies your trading power. But, and this is probably the most important but in all of trading, leverage is a double-edged sword. Yes, it magnifies your wins, but it will magnify your losses just as fast. This is the #1 trap for new traders, which is why risk management isn't just a good idea, it's everything. And your #1 risk management tool is the stop loss. It's a simple, automatic order you place that basically says, hey, if the market moves against me by this much, get me out of the trade. No questions asked. It's your safety net. It ensures you never lose more than you decided you were willing to risk. You see, successful traders think in terms of risk to reward. They only get into trades where the potential profit is at least 2 or 3 times bigger than their potential loss. With a simple rule like that, you don't even have to win every time. Your bigger winning trades will easily cover your small losses. So you get the core concepts, you know about the tools. What's the practical, smart, and safe path to actually getting started? The journey for every single serious trader begins right here.
Step 1. Find a regulated broker. But the most crucial step of all is to immediately open a demo account. Think of it like a flight simulator for trading. You get to practice with virtual money, but in real, live market conditions. All of the experience with none of the risk. And here's the secret. You have to treat that demo account like it is the real deal, because the habits, the strategy, and the discipline you practice with that virtual money are the exact same skills you are going to need when your own cash is on the line. Master the process here before you risk a single real dollar.
And that's our breakdown. You now have the foundational framework for how Forex works, from currency pairs to market trends and, most importantly, managing risk. The market is a world of opportunity, for sure, but it demands discipline. So the real question isn't just if you're ready to start, but if you're ready to start smart.